Hi everyone. Last week was quite hectic. Traders digested the Fed's meeting results and the Nonfarm Payroll report. These two events had an impact on market sentiment. However, while the Fed's hints fueled optimism, economic indicators on the contrary undermined it. The PMI Services Index, which accounts for more than two-thirds of U.S. economic activity, rose sharply in January. Hence, investors are now confused. This report made them doubt the Fed's further steps on monetary policy. This week will be calmer compared to the last one. Nevertheless, there will be some events that could stir up volatility. Jerome Powell's speech is in the limelight. Speculators hope to receive more clues about monetary policy. Apart from that, they are also closely following earnings reports, which are likely to impact the stock market significantly. Big tech companies revealed downbeat earnings results last week. Apple released a better-than-expected report, unlike other tech giants. Investors are now waiting for earnings results from PepsiCo, Disney, and CVS Health. Watch our video review till the end and find out more interesting details. Leave your comment down below. Let's start. The U.S. stock indices soared to 5-month highs after the Fed meeting. Such a reaction was quite surprising, given the Fed officials did not say anything new. The central bank will continue raising rates, albeit at a slower pace. Perhaps investors cheered Powell's statement about the start of the disinflationary process. Market participants factored in less hawkish remarks and the likelihood of monetary easing long before the meeting. Some reputable analytical agencies stated that March could be a turning point. The regulator could undertake a 25 basis point rate hike and stop the tightening cycle. It's hard to say whether such predictions are correct. Besides, fresh macro stats give no clarity. The labor market report signaled that the Fed would continue monetary tightening until the interest rates rise above 5%. Traders also analyzed the disappointing revenue results. Before the release of NFP data, stocks were already facing bearish pressure due to dismal earnings reports of big U.S. tech companies. Amazon shares fell by 8.4% and the Alphabet stock lost 2.7%. Apple reported worse than anticipated results for the first time since 2016. Later, its shares recovered, offsetting losses. Nevertheless, such results made investors extremely worried. Apple's intraday losses reached 8%. It shed $180 billion in market cap, the steepest drop in the history of Wall Street. It was also the biggest drop since March. Back then, the company sank by almost 13%. Last Thursday was a rotten day for tech companies, with their shares plunging rapidly. Apple declined the most among all 30 companies in the Dow Jones Index. The Dow sank by 2.8%, while the S&P 500 fell by 3.5%, and the NASDAQ tumbled by 5%. Notably, Apple's intraday losses exceed the total market capitalization of about 35 of the smallest companies included in the S&P. The main reason for such downbeat results was weak sales of the iPhone 14. It significantly affected the quarterly results. Sluggish sales led to a 13% decline in profit and a 5% slide in revenue. The question is why the iPhone 14 was less popular than the iPhone 13. Maybe it failed to meet the expectations of users. Speaking about losses, Apple referred to China as the main reason for such decrease, namely the lockdown imposed on Foxconn. This is the main iPhone factory in the country. China's tough restriction measures disrupted shipments of new smartphones during the pre-Christmas sales period. If this is the real problem, investors have nothing to worry about. However, some analysts note that customers were also disappointed with the iPhone 14 because it is almost identical to the previous model. Perhaps Apple will surprise its clients with a new iPhone 15. Despite such gloomy results, Apple shares managed to rebound. As for the benchmark indices, they traded mixed last week. The Fed's meeting sparked optimism on Wall Street. However, as it often happens, it quickly faded away and a correction occurred. What's more, economic data also exerted pressure on stocks. The indices ended Friday in the red zone. However, the week as a whole turned out to be profitable. Wall Street has made more attempts to start a rally since the start of this year. Cooling inflation increased expectations of a less aggressive tightening by the Fed. The Dow Jones showed the worst result, closing the week with almost no gains. The first day of the week was quite unsuccessful for all indices. On Monday, they fell as investors once again revised the prospects for monetary policy. In addition, they were concerned about mounting tensions between the United States and China. So, there were new weighty arguments for further rate increases. Investors refrained from opening new positions ahead of Powell's speech. They hope that Powell could provide more hints about further tightenings aimed at capping inflation. The S&P 500 index fell into negative territory, losing 1% last Friday. During the week, it gained almost 2%, notching the second weekly increase in a row. At the start of the new week, the S&P remained in the correction phase. One should pay more attention to the weekly rise. It is still risky to increase long positions. Despite quite impressive growth, including the NASDAQ 100 index, which has climbed by almost 15% since the start of the year, investors are still anxious. There are many pitfalls now, so their uncertainty persists. Besides, it may continue even after Jerome Powell's testimony, as well as the comments of other Fed policymakers this week. Meanwhile, the technical indicators signal a further rally of the S&P. The index appreciated above 4,100 amid strong bullish momentum. The resistance level is located at 4,325. One should also pay attention to the levels above 4,110. The S&P is hovering at 4,120, the upper limit of the range since September. If it breaks through this level again this week and consolidates higher, the upward movement will prevail. If it rises above 4,120, it could test 4,215 and 4,310. A bearish bias is still possible. Returning to the 3,950 level and below will be the first step towards the bear market. If so, the support levels are seen at 3,925 and 3,880. The NASDAQ 100 ended the week on an optimistic note, even despite a 1.6% decline on Friday. The index gained more than 4%, extending its fifth week winning streak. In general, technical indicators give a buy signal with a 90% chance of a steady rise. This year may be more beneficial for stocks. Such a buy signal occurs when stocks show growth in 3 different time periods. This is the Santa Claus rally at the end of December, the first 5 trading days of January, and the whole of January. Should we rely on such a pattern? It is up to everyone. However, it is better to make decisions with a cold head. A similar situation took place in 2019 and 2012. For example, the S&P 500 climbed by 29% and 13% respectively at the end of the year. Not everyone believes in this scenario. JP Morgan expects the S&P to fall by at least 10% in the first half of this year. The risks of a recession in the US economy remain high due to aggressive tightening. Other American banks are also betting on a further drop despite the January rally. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you!